On Point with Craig's Investment Partners.
All right, good morning, all. As always, remember the information provided here is general in nature. It's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any decisions, we always recommend you contact an investment advisor, and you can find out more about our investment advisory services at our website, which is craigsip.com. All right, let's get into it. Happy King's Birthday weekend, everybody. Feels a bit weird to say that, but that's what we call it now, don't we? I've had a good one so far. Good, bright, sunny weather. The Warriors had a fantastic win, and markets are in good shape too. So let's talk about that last point most specifically. Last week, another strong one for US shares. The S&P 500 was up 1.8%, which actually sees it at its highest level since August last year. So it's been a good 9 or 10 months since it's been where it is. And a lot of that strength came late in the week, which is why other markets around the world maybe have lagged a little bit. But investors were very happy about the resolution we saw to the debt ceiling debate. And there was also some good things in the jobs report that came through on Friday night, evidence of an easing labour market slightly, which is good from an inflationary perspective, as it means that we maybe won't see too many more interest rate hikes, maybe no more interest rate hikes. We'll have to wait and see. But the S&P 500 in the US is now up 11.5% this year. So it's been a very strong rebound. And if you account for the weakness in the New Zealand dollar, and the Kiwi dollar's been down about 4.7% against the US dollar, then US shares are up almost 17% in New Zealand dollar terms, which is a fantastic return. Other markets a bit more mixed last week. Europe was up, but only marginally. The UK and Australia were down, but again, only marginally. The New Zealand market was up 0.4%. So most other markets were fairly flat, but my suspicion is that you might see a bit of that US strength flow through to some of the other markets early in the week. Not New Zealand, obviously, because Monday is a public holiday, so we'll be shut. But potentially Australia, Japan, some of those other regions that were closed when you had that strong day on Friday. Interest rates off the boil a little bit. The US 2-year Treasury yield fell from 4.6 to 4.3. The 10-year yield fell as well, from 3.8 to 3.6. And in the local market, we had interest rates falling as well. Our 2-year swap rate at 5.2, the 5-year it's at 4.4. Bonds have continued to perform solidly, and the NZX Corporate Bond Index, which is a good proxy for what many private investors own in their fixed income portfolios. It's probably not a bad one for what many KiwiSaver or other funds own in terms of their New Zealand bonds. That was up 0.5% last week. So year to date, it's up 3.3%, not far behind the New Zealand share market, which is up about 3.5%. Like I said, the Kiwi dollar has been a positive driver all year for not only exporters but investors in international shares. Last week it was little moved against the US dollar actually, but it did fall 0.8% against the British pound. So we've had a similar tailwind, actually a bigger tailwind against the British pound. And for our for any holdings in UK shares, the Kiwi dollar's down at more than 7% this year against the pound. So if you look at the UK FTSE 100, it's up about 2% this year. So it's a relatively modest gain, but in New Zealand dollar terms, more than 10% up. So that's been pleasing as well. We were also off quite a bit against the Aussie dollar last week, down 1.2%. And the Aussie dollar found itself in favour because they had their monthly inflation reading come out, and it was stronger than expected. So that got people thinking that you might see further interest rate hikes across the Tasman, and that's probably a good thing for us that the Kiwi dollar's off a little bit against the Aussie dollar, because they are our biggest trading partner. Sorry, they're not our biggest. China's our biggest, but Australia's not too distant second. We do trade a lot with Australia, and it's very helpful if we're a little bit weaker against the Aussie dollar from an export perspective. Just think about all those Australian tourists that come here, and they're more likely to come here, more likely to spend. If there's a favourable exchange rate. Right, so if we look back at the key events from last week, we'll start locally and then we'll sort of move further afield. We had business confidence, the ANZ Business Outlook survey, pretty good result. Headline sentiment improved, so it's still sitting well below the long-term average, but it's also the highest since late 2021, which is good. The own activity measure, and that's the part of the survey that you want to watch more closely if you're trying to gauge where economic growth is going in the future, because it tends to be much more reliable in that regard. It improved as well. It's still subdued, but it's the highest since October last year. Inflationary indicators look still high, but moving in the right direction. Pricing intentions did fall again. So they're still much higher than the Reserve Bank would like, but they're well down from the peaks that we saw early last year. And that pricing intentions component of the survey is actually the lowest since March 2021, which is good. Wage growth still strong, but we are seeing some positive signs. We had some Chinese economic data, the PMIs, Purchasing Managers Indices. They were a bit of a mixed bag. The official PMI came in at 52.9, which is okay. You want to be above 50. 50 is the break-even point that separates contraction from expansion. So you want to be above 50. So 52.9 is not terrible, but it's down from last month. It's the weakest we've seen since January of this year. And I think what you are seeing in China is just a bit of a sluggish recovery. They have rebounded from a weak 2022, but the recovery has been fairly fragile, fairly uneven, and to be honest, it's been more disappointing than what many people would have hoped. Everyone was hoping China would sort of come back with a vengeance after being pretty much closed for all of last year with those very harsh COVID restrictions, and we've seen a pretty weak sort of rebound, to be honest. So that's something we've got to keep an eye on. You know, the world's second biggest economy, New Zealand's biggest trading partner, Australia's biggest trading partner. The US data was pretty good, though. We had the ISM index, the Institute for Supply Management Index. We got the manufacturing figures, which were okay. They were still pretty lackluster, but that was kind of what we were expecting to see. The manufacturing sector has been soft in the US and everywhere else. It's the services sector that has been providing all of the strength. We won't get the ISM Services Index until Monday night. So my suspicion is that will look much stronger than what we saw last week for the manufacturing index. But again, the inflationary indicators were encouraging. We had the prices paid index, which is an index of how much producers are paying for goods, and that sort of tends to be a bit of a leading indicator for what you see in the consumer space. That fell more than expected, so that's the lowest we've seen in a few months. So that was positive. We also had the US jobs report come out late in the week, and this came out on Friday night, so you don't get it until Saturday. So many markets around the world wouldn't have had the chance to react. And definitely some good signs in here. Bad signs if you want to look at them with a glass half empty lens, but I always err on the side of being glass half full. And in that regard, it sort of hit the sweet spot. You know, markets chose to see it in a positive light too. It was good enough to provide confidence about the economy, but there were also signs of the labour market and wage pressures easing, which is something that's really important for central bank policy and to see inflation continue coming off the boil. So the US economy added 339,000 jobs in May, which was well ahead of forecasts. Markets were expecting, or economists, I should say, strategists were all expecting 190,000. And so 339, obviously well above 190, well above 294, which was what we saw in April. That was revised up, but the main numbers still were still higher. The unemployment rate did increase a little bit. It increased to 3.7%. So that's still very low in the context of history, but it's the highest we've seen since October last year. So 2 points I'll make there. One, um, the reason the market took that higher unemployment rate well is that just does suggest that you're starting to see some of that incredibly tight labour market, those really tight conditions ease a little bit, which means that the pressure might be off sort of wage growth and so forth. And we saw that in the average hourly earnings for the month. They came in at 0.3%, down slightly from a month ago. The annual change in average hourly earnings slowed to 4.3%, which is still high, but that's the equal lowest with March, a few months back, the equal lowest since the middle of 2021. So another step in the right direction. The other thing, I know what you're thinking is, hang on, did you just say the US economy added jobs, but the unemployment rate went up? That doesn't make sense. You're right, it doesn't. What you need to remember about these two surveys, well, is that there's two of them. There's two different surveys. So you have the payroll survey, and that's the one that relates to the non-farm payrolls, new jobs or lost jobs or whatever. So the 339,000 jobs that comes out of the payroll survey, which is a survey of companies, and then they also have the household survey, and that is a separate survey. They survey households, and that's the one that sort of drives the unemployment rate figures. So, as with any statistics, there's a few swings and roundabouts. They sort of have a slightly different approach, and the numbers won't always line up. So that might sound illogical, but it's just I think any statistic is a little imprecise, is a little imperfect. So you don't get too hung up on that. I think what we all do when we're those of us that follow these things really closely, we'll look at both. They're both important pieces of the puzzle. You take everything with a bit of a grain of salt, because that's just the nature of numbers and statistics and so forth. So they're useful, but you don't hang your hat on them completely. I think what I would say with these sorts of surveys is you look at those numbers and you compare them to their own history. So if, we can look at that jobs number, we can compare it to where it's been. We can look at the unemployment rate and compare it to where it's been, and that is a bit more of an apples with apples comparison. I guess if you were to sort of look at this in a more cautious way, you might say, well, hang on, why is the market getting so excited about the unemployment rate going up to 3.7%? Because that's quite a big increase from the previous month. I think it was 3.4 the previous month. So that's an increase of 0.3%. And that's a big increase in just 1 month. So it's not all good. There's a negative side to that. It's good from a inflation sort of wage growth perspective, because it sort of takes the edge off there, but it's not so good from an economic activity perspective, because we haven't seen a rise as big as that since the COVID period, since March and April 2020. And that was such an unusual period because of, going into lockdown and all of those lost jobs. If you take those 2 months out of the mix, we actually haven't seen a month-on-month increase like that since 2010. So, while this is good from a Federal Reserve perspective, what will they do next? It's also something we need to keep an eye on for what it means in terms of economic activity and corporate earnings growth and so forth. So the Federal Reserve meets next week. So it's something we'll talk about in a week's time. But they meet next week, and I think the outcome of that decision will be due next Thursday morning at 6 a.m. So not this week, but next week, although that is the next key event for markets. And this jobs report was an important one for what they might do. People had been expecting the Fed to hike at that June meeting. We had some strong economic data, some strong inflation data last week. Sorry, the week before last. We talked about it last week. And that sort of pushed people to think, well, maybe they will hike in June rather than pause. But now people are sort of back in the pause territory. And I think the odds are sort of 70-30 in favour of a pause. So that's important, because that could signal the end of the current monetary policy tightening cycle in the US, which would be a really important milestone for the US economy and a really important one for financial markets. And I did a whole podcast and report on what that could mean for the share market and the bond market, both in the US and in New Zealand, because we're in a similar position with the Reserve Bank of New Zealand, where we think they're probably done. We're never 100% sure, but we think that's probably it. And go back and have a listen to that. It was a really interesting one. Anyway, so that was last week. Looking ahead to this week, it's a pretty quiet one here in NZ. Obviously, markets closed for the King's birthday public holiday, so it'll be a 4-day week. Hopefully we'll start the week well on Tuesday, given the strength we saw last week across international markets late in the week. But in terms of economic releases, corporate releases, there's not much. We've got a dairy auction. That'll be out on Wednesday morning, and we've obviously seen a bit of weakness across the dairy sector in terms of prices. 3 weeks ago, the last auction prices slipped, so the GDT index down 4.6% this year. It's more than a third below where it got to March last year, although that was a 15-year high, but it's still been a big fall since then. The currency weakness will be helping. But Fonterra's cut their payout forecast 3 times this year for the 22-23 season. And most recently, they did that at their full year result, which is in May. So they've now got a midpoint of 8.20 for the 22-23 season, which is just drawn to a close. And in terms of the upcoming season, the 23-24 season that we're just entering, they've got an opening forecast range of 725 to 875, so it's a pretty wide range. They don't know how things are going to go, so that range tends to start out wide and then sort of tighten as the year progresses and they get a bit more confidence. But at the moment, the midpoint's $8, so a little bit down from 2023. And down from the previous year. It's still not bad in the context of history, but I think what we all need to be conscious of is the fact that the farming sector, like all of us, is facing much higher costs than it has in the past. So if you own a farm and you've got debt on that farm, that debt's obviously a lot more expensive to service. You're also facing labour shortages, quite acute ones actually across the agricultural sector. The wage bill is a lot higher than it was. Things like fertilizer and other inputs have also gone up substantially. So, $8 in terms of a payout isn't what it was a few years back. So that's where things are at, and we will just have to see how things progress. But that dairy auction, probably the key release of this week, Wednesday morning. Hopefully, we see some stability or a bit of an uplift would be nice. Elsewhere, it's a busier week across the Tasman. There's 2 key things to keep an eye out for: the Reserve Bank of Australia decision on Tuesday afternoon, and then first quarter GDP out on Wednesday. And our GDP report will follow later this month, late June. The Aussies are always a week or 2 ahead. But the RBA will be really interesting. So they are at 3.85%. Which is the highest since 2012, and not too far from the peak through that era. The RBA cash rate peaked at 4.75 back in 2011, but they did surprise everyone a month ago. Everyone thought they would pause, but they increased their cash rate. So this week we're all looking at what they might do and thinking, well, will they surprise us again? We did have that strong CPI release, that inflation report. That was a bit of a surprise. It came in much stronger than people had expected. So markets are sitting around the 50-50 point for what the RBA might do. So I think you're going to see you're going to see a market reaction either way, because they'll either go 25 and you'll get a market reaction because that's only 50% in the price, or if they sit tight and do nothing, you'll get a market reaction, because that's only 50% in the price. So markets are hedging their bets because they don't know, and you'll see a reaction in things like Australian interest rates, the Australian dollar, the Australian share market. But that will be the key release Tuesday afternoon. Further afield, the ISM Services Index in the US on Monday. We've got Chinese inflation figures late in the week there on Friday. We've got some industrial indicators in Germany, and markets will just be sort of looking ahead to that really important June Federal Reserve meeting, which is next week. We won't hear much from the Federal Reserve speakers. They won't be on the speaking circuit because they're in that blackout period. They're not allowed to go out and speak at functions when they're, getting close to having that meeting. So we won't hear from them, but markets will be looking ahead to that. There's actually a US inflation report, I think just the day before. So that will be really interesting timing. But that's next week. We'll talk about all of that in a week's time. Otherwise, it's probably it. Not a lot on the corporate calendar either. I know Scales, fantastic local business based down in Christchurch. Apple's pet food agribusiness. Scales has got an AGM on Wednesday, so the market probably be quite interested in hearing what they've got to say. The Apple business was impacted by the cyclone and the weather in Hawke's Bay, so maybe there's an update on how things are tracking there. But pet food is a bigger part, I think, of their operations these days. So that's something that some people haven't really caught on to. That's not all about apples anymore. But other than that, not much else on the corporate calendar. A couple of international results, but fairly quiet. So that's all I got. Thanks for listening. Much appreciated as always. If you've got any feedback for us, fire it through. If you've got any topics that you want me to sort of look at and address in these sessions, whether it's the back to basics stuff, whether it's investing 101, whether it's just explanations of things you've always been wondering about, happy to sort of try and address some of that investor education, sort of those sorts of topics, as well as what's happening across markets, right at the minute. So you just let us know. And as always, our advisory team right up and down the country would love to talk to anyone that we can help in terms of wealth management or anything else we could do for you. So don't be afraid to get in touch. All right, until next time.
For more insights, visit craigsip.com.